Data released this Wednesday shows that the U.S. April CPI increased by 3.4% year-over-year, aligning with expectations and slightly below the previous value of 3.5%. It grew by 0.3% month-over-month, below the expected and previous value of 0.4%. Excluding food and energy costs, the core CPI month-over-month growth rate in April dropped from 0.4% in March to 0.3%, marking the first decline in 6 months and meeting the expected 0.3%. Further breaking down the core CPI, it consists of core goods and core services. The resilience of the core CPI is mainly evident in services. The good news is that core goods have entered deflation, with the extent of deflation slightly expanding. The positive news for service inflation is that both month-on-month and year-on-year rates slightly declined in April, but remain relatively high, underpinning the resilience of the core CPI. Following the data release, the yield on 10-year treasuries continued to probe lower, falling by 9 basis points in a single day, now approaching the lowest point since April. The stock market also performed exceptionally well, briefly reaching 40,000 points and setting a new historical high. Unknowingly, since the stock market crash triggered by the pandemic in April 2020, the index has doubled over 4 years. Moreover, markets like the US dollar index and gold also responded positively, improving market sentiment and increasing optimism about impending rate cuts. According to the latest data from FedWatch, the market still expects the Federal Reserve's first rate cut to occur around September, with about a 67% likelihood, largely unchanged from before the CPI release. The market's stronger-than-expected performance and data that met expectations have led to an inconsistency. Typically, if the final CPI results align with market expectations, the market should remain within a narrow fluctuation range rather than experiencing significant rises or falls. Although April CPI data performed well, this good performance is better than past data performance, not current market expectations. The market's 2-week decline prior to this data release also indicates that it had priced in the expected CPI data. Yet, the just-released year-over-year increase of 3.4% in CPI, matching market expectations, triggered a further drop in Treasury yields, a seemingly paradoxical phenomenon. This unexpected drop in Treasury yields is largely due to the residual impact of Powell's speech at the interest rate meeting on April 30th. During the meeting, Powell clearly outlined 2 paths toward rate cuts: an unexpected increase in unemployment rates and CPI growth below expectations. Last week's April job data showing a weakening job market and the inflation report indicating cooling inflation, alleviating second-round inflation concerns, led to an increase in market risk appetite. However, although inflationary pressures have eased, achieving the Federal Reserve's inflation targets remains challenging. The Economic Outlook summary from the Federal Reserve's March meeting expects PCE inflation by the end of 2024 to be 2.4%, and core PCE inflation to be 2.6%. Based on historical data, to achieve these targets, CPI would need to drop to 3.2% and core CPI to 3.1% year-on-year by the end of 2024, meaning both CPI and core CPI would need to average below 0.2% month-on-month. Achieving these targets is not straightforward. Additionally, consistent with the Federal Reserve's style of managing expectations, when market sentiment continues to improve, officials will likely release hawkish statements to stabilize the market. Since solving inflation requires time, even under the best trends, inflation won't be resolved overnight. Moreover, the Federal Reserve prefers to reduce market volatility as severe fluctuations are not conducive to solving problems and might even lead to more issues. Given this, during the upcoming period without data releases, many hawkish statements might emerge, influencing short-term increases in bond yields and interest rates. To minimize the risks of uncertainty, it is advisable to lock in mortgage rates and secure equity assets.